And I think, to Alasdair's point, the one thing about having gold and silver in your hand is it is an asset that has no counterparty liability. And if you do it before the masses figure it out, like the way the central banks started doing this 5 years ago, 6 years ago, 7 years ago, and then the others being the sovereign wealth funds and the commercial banks, these are people at the highest level. So yeah, I would say it's everything. And to Alasdair's point of the ETFs being expensive, yeah, you're paying BlackRock and JP Morgan a 60 basis point management fee to, in essence, use your metal to drive the price down. There's an 81 million share short position in SLV right now. And what that? It's just, as Ed Steer says, it's grotesque. And it is. This drives the price down.
Despite weeks of erratic market movement, gold is currently trading at almost $4,000 an ounce and silver at about $48. The conventional wisdom maintains that the advance is over, that precious metals have reached their high, and that a correction is imminent. However, Andy Schectman claims that this is not the conclusion of the tale. It is the last preparation before a historic revaluation of real assets, the quiet before a financial storm. According to Schectman, the most influential financial institutions in the world, central banks, sovereign wealth funds, and billionaire family offices are not selling behind closed doors. They are building up. They are actively and covertly accepting physical deliveries of gold and silver, removing metal from Western vaults and exchanges. The same organizations that used to make fun of silver stackers and gold bugs are now getting ready for what Schectman refers to as the Great Reset of wealth. The brightest money in the world is shifting to tangible assets that you can touch, hold, and safeguard as Wall Street continues to dabble with paper contracts and digital promises. Don't forget to like, subscribe, and ring the bell for the latest analysis on gold and silver markets.
Michael Hartnett's newsletter is so expensive that no one mainstream reads it unless you are a institutional sized trader or hedge fund, running a hedge fund or whatever. These people at the top level are being given the acknowledgement, the wink of the eye, if you will, by the same banks that have been suppressing the price. At the same time, we've talked at length about, and I started my first couple podcasts with you in 2020, we talked about the others that showed up on the Commitment of Traders report, which there was always just two groups of reportables. The largest positioning in the Commitment of Traders report published by the COMEX were the hedge funds and the commercial banks. Then all of a sudden there's this group called the others. Who are they? They are sovereign wealth funds. They're central bankers wearing a different hat. They're friends. They're an offshoot, if you will, or family offices of tremendous wealth started standing for delivery, which I'm like saying to you, Dunnigan, this never happens. What, less than 1% have stood for delivery my whole career? At this point, it's been 30 years I've been doing it. Something's not right. And now we see it. Of course, we've seen it with almost 40 central banks repatriating their gold from the Bank of England and the New York Federal Reserve. Early adoption into backwardation right now. We see problems of getting the metal. Sorry, there's a 8-week delivery delay, folks. We have a shortage of manpower and trucks in London, we were told. Or, not really a good example, but gets the point across. Venezuela says to Bank of England, can we please have our gold back? No, you can't. And when you see 40 countries pull their gold home from the Bank of England and New York Fed, they were there because for many years you had the Western rule of law and stable, liquid, efficient markets, the COMEX and the LBMA. They don't care. And you're seeing exchanges, the Shanghai Metals Exchange and their expansion in multi-jurisdictional expansion, one being built right now in Saudi Arabia, one just completed in Hong Kong, which allows you to take metal off of the exchange through Hong Kong and receive it directly by trading yuan into it. The people who are doing this are the central banks, and they are the most well-informed traders on the planet. That's number one. Now it's moving to the commercial banks who are telling their institutional-sized clients, early adoption is everything. And this is why most people fail at investing, because they move rather than trusting their intuition and listening to the rants of a guy like me. What the hell do I know? Or Alasdair, what do we all know? Well, we've been right. And we have been right. By hook or crook, we've been right. And, we were laughed at. And you look at an environment where Wall Street refuses to acknowledge it, but now they are at the highest level. But they don't tell you, yeah, we've been wrong. We laughed at all of you guys who wanted to buy gold and silver, yet it's outpaced the 10-year Treasury 2-to-1, doubled it. It's beaten the S&P 500 with with dividends reinvested for 25 years, which, by the way, no one ever does. No one ever does reinvest all their dividends. But we are living in an environment of negative real rates, and you could argue yield suppression, where they're trying to keep the yield down best they can, monetization of assets. And this has pushed investors for a long time into risk assets, which have inflated valuations, like all the Mag 7. And it's hiding the risk. And that risk hiding, well, the insiders know. Why do you think they're leaving? As the public's chasing that FOMO. This isn't free market pricing at all. And the assumptions of return are off. You can't make these assumptions in this environment. And I think, to Alasdair's point, the one thing about having gold and silver in your hand is it is an asset that has no counterparty liability. And if you do it before the masses figure it out, like the way the central banks started doing this 5 years ago, 6 years ago, 7 years ago, and then the others being the sovereign wealth funds and the commercial banks, these are people at the highest level. So yeah, I would say it's everything. And to Alasdair's point of the ETFs being expensive, yeah, you're paying BlackRock and JP Morgan a 60 basis point management fee to, in essence, use your metal to drive the price down. There's an 81 million share short position in SLV right now. And what the hell is that? It's just, as Ed Steer says, it's grotesque. And it is. This drives the price down. It allows them to pull metal off elsewhere. But, you're paying them a 60 basis point management fee. You can store in one of our Brinks facilities for a fraction of that. Real stuff, which you can never take possession of SLV or GLD. It is expensive. But through all of this, and even this month where we've seen a big fallback of 10%, 58,639 contracts taken off. Multiply that times 100, you got 586,000 ounces of gold. No, 5,863,900 ounces of gold taken off the exchange, and multiply that times 4,000. So you're talking an awful lot of money worth of gold coming off just this month, but it's been that way every month since November. So what's the takeaway? Well, the takeaway is this. Starting in 2017 or 17, the central bank started buying and repatriating their gold. And then it proceeded to be the family offices, the hedge funds, the sovereign wealth funds. Now it's the commercial banks are telling us this. And at the same time, but that excluded the New York traders all this time until November of this year. And now every month you're seeing deliveries like this.
The recent market correction, according to Andy Schectman, started in the after-hours access market when liquidity was at its lowest and big institutional players could affect prices with little opposition, rather than during regular U.S. trading hours. He thinks this was a deliberate, short-term shakeout intended to drive down prices and enable big companies to buy more actual metal at a lower cost. He also draws attention to the system's logistical problems, including as 8-week delivery delays, London workforce shortages, and an enormous 81 million share short position in SLV. While large institutions utilize those same holdings to reduce prices and accumulate real metal elsewhere, retail investors continue to pay management fees. Billions of dollars worth of gold and silver are taken out of Western exchanges each month. China has further tightened its hold, which is anticipated to reduce supply and raise domestic prices. It is evident that the global financial system is moving toward hard, tangible value when one considers the Fed's persistent inability to control inflation, negative real yields, and the breakdown of the conventional 60-40 portfolio model. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
Tangible asset as part of a mix.
Yeah, I think it's important to highlight those in the respect that a lot of what Alasdair is talking about it deals with just this: monetary inflation, asset valuation, the inflation-adjusted value of bonds and equities. When you have a Federal Reserve that has missed their target inflation rate for 55 straight months or thereabouts of 2%, in fact, missed it by 50%, they call that tepid. I don't know how missing your rate by 50% is tepid. It seems kind of way off base to me, but there's a lie, of course, about what inflation really is. It should be called the CP lie and the BS, not the BLS. And we know that. We've talked at length. John Williams says inflation's 11%, shadowstats.com, not 3. So nominal returns, to Alasdair's point, are an illusion when inflation certainly is higher than we think. But, even at 3%, and they're trying to push rates down below that, but even say you get a 5% return, right now you're losing in real terms by John Williams' measurement, a negative 6% real return. And in that environment where you, to Alasdair's point, have record participation by the public in the equity market, record amount not only of margin debt over $1 trillion, but also record speculation and leverage with options. Bonds are very vulnerable, and equity valuations are very distorted. So earnings may rise, but real purchasing power is falling. But the real trouble, to Alasdair's points, in the bond market, and that's why when you see the chief investment officer of Morgan Stanley come out and say, well, the 60-40 rule that we've used, 60 stock, 40 bonds for 50 years. Now remember, and since 1982, when the interest rates have fallen straight down at a 45-degree angle, if you're 60 stock, 40 bonds, you'll retire wealthy, period. That's not really the case anymore. And so as the chief investment officer of a large commercial bank who has never acquiesced to anything more than a pittance of gold in your portfolio, he says, sell half your bonds and buy 20% gold, 60-20-20. You got Michael Hartnett, the chief analyst at Bank of America, says, no, shouldn't be that either. It should be 25, 25, 25, 25. Stock, bond, short-term treasuries, gold. You have Jeffrey Gundlach, the bond king. He's the head of bonds for BlackRock, says, 25% allocation to gold is not overweight. This is a guy that's made his living selling bonds, the antithesis of gold. And you have all of these institutional level advisors and chief investment officers saying, you need to own some gold right now. And in all three cases, it's at the expense of the bond portfolio. You didn't hear them say trim your 60% stock portfolio. So right now I think there is no question that the world is beginning to understand that not only is the Fed trapped, raising rates blows things up like the bond market and all of the institutions that hold their wealth in treasuries, like the banks and the insurance companies, and the real estate market. And we're already looking at a Fed, they're projected here to lower rates into an environment where they're missing their target by 50%. That's acquiescence. We're going to give up in essence our mandate without really acknowledging it to inflation target of 2%. And by the way, it's funny, as a side note, just for those people who haven't heard, I asked Judy Shelton, I said, Judy, why the hell did they ever come up with this stupid 2% rate anyway? Shouldn't it just be zero, flat prices? Wouldn't that make standard of living better? She says, it was Janet Yellen's husband who came up with it actually. And he said, if you do that, you can't give your employees raises because it'll come from the bottom line if everything is stable. But if you have a 2% inflation target and give your employees a 1% raise, they feel like they're getting ahead even though they're falling behind. And that's really what's happening here. We're all falling behind in the face of a dollar that is losing value precipitously. Last thing I will say is that when we look at the value of the dollar in terms of purchasing power, which is important because that's really what it is. Alasdair says you might get your money back, but what's it going to be worth? We're misled by measuring it against the Dixie, the other crap currencies that are all losing value. And the dollar was down 11% against these crap currencies. It's rallied back to 7 or 8%. Okay, but let's measure it against gold. It's down 50%. Against silver, 60. How about last year? Same thing.
Andy Schectman makes it very evident in his concluding remarks that the financial system we live in is based on false trust and skewed statistics. He begins by pointing out that the Federal Reserve has failed to meet its 2% inflation objective for more than 55 months, frequently falling short by around 50%. He explains that inflation is closer to 11% rather than 3% if we utilize actual statistics such as that from John Williams at ShadowStats. This means that even if your investments or savings generate interest of 5%, you are actually losing about 6% because your money doesn't buy as much each year. Therefore, even though the stock market appears to be doing well, Schectman cautions that this is not true growth because it's based on debt speculation, and cheap money. Schectman dispels the idea of the strong dollar in his conclusion. The only reason the US dollar appears strong is when it is contrasted with other weak currencies. However, the dollar has actually lost more than half of its value when compared to gold and silver. Silver has increased even more than gold, which has increased by roughly 50% against the dollar. Simply put, Schectman claims that the system is set up to conceal the dollar's decline in value. The outdated financial guidelines, such as depending on bonds and believing inflation statistics, are no longer applicable. We are currently witnessing the gradual collapse of a system built on deception and debt. His message is very clear. Avoid relying on paper money and paper promises if you want to safeguard your riches. The only real method to maintain value in the next years is to invest in real assets like gold and silver. Thanks for watching. If you like this video, give it a thumbs up, subscribe, and turn on post notifications so you never miss an update.